Welcome back, students who are taking financial accounting, and in this series of videos we are discussing the theory for Chapter 8, which is on long-term and other assets. And let me get down to the slide. 1, 2, 3. There we go. So in this series of videos, in this video itself, we're going to talk about the cost of repairing fixed assets. And let's just use our automobile. Let's just use an auto, right? And I had talked about this earlier in the cost of fixed assets section here, when I gave this here idea of, if we buy an automobile, and what I'm talking about here is the book value, okay? If I buy an automobile brand new and it costs $50,000, and I know I'm repeating myself, but this will help you to better understand these three categories. If I buy a brand new automobile for $50,000, when I enter it on my books, I'm going to debit the auto for $50,000, and I'm going to credit cash. Let's assume we paid cash for $50,000. So now it's on my books, and I put it into service. Now remember, what we're talking about is when the asset goes into service. Right? Because once it goes into service, if it needs to be repaired, okay, it can no longer go against the book value. It has to be the repair has to be expensed. Okay, and that repair is known as an ordinary, repair, and that if it's an ordinary repair, that gets expensed. But I had also talked about, let's say we buy a used van, and let's say we paid $3,000 for that van, okay? And then we had to put $300 in for, I don't know, alternators, $600 for tires, and $100 for a tune-up for an additional $1,000, okay? Now remember, we're not, this van is not in service just yet, okay? We're preparing it to be put into service. So our van account will show the $3,000, the $300, the $600, the $100, and so our book value of our van is going to be $4,000. Okay. Then, if that's all it takes in order to be able to put it into service, once it's on the road and it's in service, then if we have some repair, okay, that repair is going to be expensed because it's an ordinary expense. Okay. I also talked about repurposing the van. Let's say you bought a brand new van for $25,000, and you repurposed it, meaning you painted, or a thought just popped into my head. One of the big items that we have nowadays is food trucks in our area. All right. Well, you have to repurpose that van in order to make it a food truck, and maybe that costs an additional $10,000 in order to be able to repurpose the van to make it a food truck. So my book value of that van is going to end up being $35,000. Okay. Now, once I repurpose it, as soon as I put it into service, if I have a flat tire, I have to have an inspection. If I have to have an oil change, those are all repairs which end up being expensed, and those expenses are based upon the is an ordinary cost of repairing the fixed asset. Right. Now, the reason why I went over all of this again, and I'm going to erase all of this, is because we have two other types of repairs that we have to consider. Now, let me use the idea of the used van. Okay, for the used van, we had $3,000 as our initial cost. We had $300 for an alternator, $600 for tires, and $100 for a tune-up. So our book value of the van is $4,000. Excuse me. We put it into service. And if we have to do any other repairs, okay, those repairs are expensed as an ordinary repair. Okay, but now let's say 1 year down the road, the engine goes on. Erase this. Let's say the engine goes on the van. Okay, we blow an engine. All right. For all intents and purposes, that van is useless. Okay. Now we have a choice. Maybe we're cash strapped or whatever, and we decide that we're going to replace that engine, and let's say that costs $1,500 to replace that engine. Right. Now, even though the van is in service, all right, the replacement of this engine isn't an ordinary repair. Okay, it's an extraordinary repair. If we didn't do this, if we didn't replace the engine for $1,500, the van would, be useless to us. Okay, so what we're doing is we're making a repair that extends its useful life. All right, and because we're adding an additional $1,500 to extend its useful life, now this is known as an extraordinary repair. And when it's an extraordinary repair, we can apply that $1,500 to the book value of the van. So now our van has a book value of $5,500. Okay, all right. So that's, think of it from, remember, we're talking about what we do in order to be able to put it into service. Okay, once it's in service, then any repairs end up being an ordinary expense. Just an ordinary repair that gets expensed. But just like these three here, we buy this van for $3,000. Well, to a certain extent, these three repairs are, we can think of those as extraordinary because we have to do these in order to make the van useful to be able to put it into service. And later on, if we have, the engine goes, well, that would be the same type of thinking as these other repairs that we would need in order to be able to make the van useful. So, and I keep on pointing out, it's what it takes to put it in service. Okay, whatever costs that that are incurred in order to take the asset, in order to make it serviceable, right, goes under book value. Once it's serviceable, then everything gets to be an ordinary expense, and any repairs are expensed. Okay, so I hope that made sense. And if not, feel free to, telephone and speak with an instructor about this. It's just a matter of thinking it through, okay, as to what would be considered a part of the original cost of the asset itself. Now, Betterments is very similar to extraordinary. Okay, Betterments increase the productivity or capacity of the asset. All right. So again, let's see here. It's hard to think of an idea what a betterment would be. I mean, they don't happen that often. Well, I just thought of something. Let's say you have a floodlight, like, and the thought that just came into my mind would be, a floodlight that you see, like, you know, the big ones that you saw in the Batman movie, right? Um, that floodlight in order to shine the light out up into the sky. Okay, that's an asset. All right, that floodlight. But as far as a betterment is concerned, all right, well, we changed the light bulb, right? Maybe we're getting a much, you know, we buy this floodlight, but we know that we can go and buy a different light bulb that increases the capacity to be able to shine really, really bright. So the purchase of those light bulbs would be part of the book value of that floodlight. So if our floodlight we originally purchased, say, for 15,000, I mean, I have no idea how much they cost, um, but we go out and we have to spend an additional $3,000 on a light bulb that, excuse me, that increases the productivity, meaning maybe this bulb lasts 3 times as long and it shines maybe 150% brighter. Okay, well, then that light bulb, when we replace it in the floodlight, now ends up being part of the book value. So our book value of that floodlight would be $18,000. Um, realize that you buy this floodlight. Now we're talking about a betterment here, okay? You buy this floodlight. That floodlight is all for 15,000. That's all you need in order to put it into service. I mean, it works perfectly fine. You don't have to repair it, okay? Um, you can buy it today and tonight be shining it up in the sky. But if you decide to have a betterment by putting in that new light bulb, okay, yeah, this floodlight is going into service tonight, but when you're replacing that light bulb, which was not part of the original, that betterment of $3,000 does become part of the book value and ends up being $18,000. So that betterment and so betterments and extraordinary repairs, okay, both of those are capitalized. Right? They're part of the book value of the asset itself. Okay. The ordinary repair is once it's in service, anything that has to be done to repair it to keep it running is expensed. So that's the difference between those types of repairs. Okay. Right. So if go ahead and reread that book. It's only reread the textbook. It's only one page, but to give you to give you some idea of what is all involved here. You have to realize that each and every asset, you have to look at it individually, and look at it each and every individual situation in order to be able to determine uh, what you do with it. But the reality is, when you're in the workplace, to me, it's kind of very, very simple. Um, if it's, like I keep saying, whatever you're going to do in order to make it serviceable, it ends up being part of the book value of, you're going to capitalize it, and it ends up being part of the book value of that asset. Once it's in service, then any repairs end up being expensed. But on the back end, in the idea of, blows an engine, you have the choice of replacing that engine. If you replace the engine, then that, of course, that gets, capitalized. Um, try to make an argument by saying, well, what if I replace the radiator? Okay, no, the radiator would be an ordinary expense, even though you're replacing an engine or you're replacing a radiator. You could say, oh, well, if I replace the radiator, wouldn't that be book value? No, that's an ordinary repair, right? Um, because that's just the radiator just wore out, due to the normal use of the vehicle itself. the engine is supposed to last, the entire time, the entire useful life of the vehicle itself, whereas the radiator is not intended for that. Okay. All right. So with all of that said, if you still have any additional questions, go ahead and rewatch this video, and if you still don't understand something, feel free to contact an instructor, and we'll talk about it as much as we need to. Okay.